years. So guys, this is the session 6. We have gone through a lot of stuff. We've gone through a lot of the culture, kind of tasting what is life like at Integrity Capital as it pertains to our culture, who we are, how we function, daily. It's not something we just slap up on a wall, but it's just the way we function every day. And so it's how we interact with each other. It's how we make decisions, which just allows us and gives us sort of a guiding light and a principle, a clear vision of where we're going, why we're doing what we're doing, where we're headed. All of that is very, very clear. And I think Michelle would agree that it's lived out, not perfectly, but pretty permanently. And so it just gives us the ability to grow and change if we have to change, and helps keep all of us accountable to where we're headed. And then we're going into, like we will talk about today, is the final session, is just a lot of content around this industry. What is this industry all about? Who are all the players in the industry? What are their roles? And what would you be doing with them? And how does that function? And so really, as we go through this final third week as sort of this pivot point for all of us, we'll be rounding up with you guys in the next 24 hours just to sort of talk about next steps. And so it's been exciting for us to be able to walk through this with you. And hopefully you guys have gained some insight into the industry, some insight and wisdom into us as we all make decisions for our future. So before I go through, I just wanted to walk down the line real quick and just ask each one of you, what's it been like for you? What have you kind of learned so far? And just give us some feedback. So Will, why don't you just kick us off with, what have you learned? What's it been like for you so far?
Yeah, first of all, I remember whenever I accepted the position, you said that this experience is going to be like trying to drink water through a fire hose. And you definitely were right. There's a whole lot of information, but I have enjoyed just getting in and just experiencing what it's like to be in this industry, but really just learning the basics, vision, mission of Integrity Capital, along with the basics of the industry. I feel like it's been great. I feel like there's still definitely a lot more to learn, obviously, but just getting the basics under my belt, I feel good about it. I feel like I've learned a whole lot already.
Great. Awesome. Thank you for sharing.
Yeah, thank you.
What about you, EJ?
Yeah, I mean, same as Will, that the whole first kind of objectives really taught me a lot personally about myself, which I really enjoyed, and pushed me in that way. And then the second objectives, getting to know the basics of kind of just the lending, commercial real estate lending, and it's been really neat, really interesting, and as Will said, a lot to learn, but it's got me excited. So I'm ready to move on.
Awesome, thank you. Well, what about you, Keelana?
I definitely agree with them. Just the first section was really great, just getting to it was like almost working on myself, as well as kind of learning how everything works with Integrity Capital. And obviously I still don't know everything, but I've really enjoyed that part. And then this past week, just getting to know the basics. And I found this a lot different than when I'm in school, because I feel like there I'm learning everything about everything, and it's overwhelming in that way, that it's like I'm supposed to know every single thing about every single part of finance. But here it's a lot more focused, and I get to just focus on loans and different players in loans and the processes and terms. So learning the basics of all that has been really cool, and getting to go from one thing and expanding and knowing that this is kind of what the focus is here.
That's good. Awesome. Thanks for sharing, Lana. What about you, Evan?
I really like what Lana just said about how school can kind of be overwhelming because you're learning everything about every different subject. This internship has been overwhelming, but in a very good way, kind of like what Will said, kind of throwing you into the fire, just absorbing as much information as possible as it's going over your head. No, it's been great. And then, yeah, I absolutely didn't expect to learn a lot about myself, my core convictions, why I have those. I didn't expect that. And that's something I'm really glad that I came out of this with, at least.
Yeah, and again, and whether we all journey together or not, it just that is the hope too, because part of your journey is just figuring out like who you are and how you're hardwired and what lane you want to run in. Like that's a lot of the, it's part of college. You're just kind of going through and going, okay, what do I like? Who am I? Where am I going to go? What's the lane I'm going to run in so that I can be the most effective that I can be. I met this morning, I'm on a board. I met with one of the um, executives, and I remember after just talking to him, I said, man, it's so fun to see you because you're so good at what you do. Like, it's just so evident that it's not something that's like hard for you. It is hard, but you're just hardwired that way. It just comes naturally and things just flow. And so that's obviously our hope for you guys, is to just that you identify that because that's when you can really have rocket fuel and take off. So that's good. Well, good. So let's dive in. We got a lot to cover. I asked you guys to go through a lot of content. And so the first thing is, life insurance companies. We talked about banks last time. If you guys remember that, do you guys remember anything about the banks at all? Something? Anybody want to take a stab at something you learned about the banks?
The banks there, I mean, obviously everyone's motivation for the most part in this business is to make money. And the way that they make money is kind of how they're, the amount that they charge on deposits versus the amount that they make on loans.
Yes. Yep. Good job. Absolutely. Right. So they borrow this money for X, they lend it for Y. There's a gap, right? And as this money goes higher, guess what happens? Kind of like when the Fed kept raising, right? Higher, 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 right? Then the rates go passed on to the consumers higher, 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 which obviously slows things down, as you guys have already seen. So that's good. Do you guys remember what that word I said, which is probably the most thing you're going to deal with, starts with an R, that you deal with all the time when you're dealing with lenders?
Is it risk?
Yes, good job. I was going to say starts with R and sounds like ISK, but I wasn't going to give it away. So good job. So yes, risk, right? Everything that they're dealing with is risk. Risk on the cash flow, risk on the collateral, risk on the credit, risk on their credibility. They're looking at risk, risk, risk all the time. And so they're assessing things through that lens. So that means you have to do the same thing when you're screening and looking at deals and looking at even clients and people. You're kind of going, okay, is this going to fit really well when all is said and done? So risk is a big one. Okay, so let's talk about life insurance companies. Okay, so do you guys remember anything like, did you ever think, oh my gosh, life insurance companies lend money? I thought they just took our money and gave us insurance, Aetna and Aflac and State Farm and all these big companies. So did you guys ever think like, oh my gosh, they lend money?
I had no idea, honestly. Like you said, I thought that they just took our money and gave us a policy, and that was that. But it was cool to see the other side of life insurance companies that I didn't even know existed.
Yeah. So what do you guys remember about just any of the sort of functions from what you learned on there about life insurance companies? Anything?
I don't remember what all of them are. I have my notes with me, but I know that there's like the acts, and so there's 3 of them, and it gives them the right to basically loan out that money. It's like they're called the acts, or like the act if you refer to it as an individual, but it's like 3 of them, and it's for insurance companies and loan companies and cooperative credit associations.
Correct. Yeah, good job. Yeah, so there's this regulatory agency around life companies now, and the reason why they have that in place, just kind of like banks too, is that the FDIC is there to protect, right, the consumer. Because if you think about it, we're giving them all this money, okay, and if they weren't real careful about how they invested that, then they could lose all of it. And if all of a sudden you have a huge disaster in Florida or Texas or whatever, and all of a sudden people are putting in all these claims and they're like, well, oops, sorry. we just lost all this money, that would be like a big no-no. And so there's regulatory things, which means that if they have a bucket of billions of dollars, they may only get to have a sliver of that fall into a certain category of lending out to commercial mortgages, right? They may have a sliver of that can only go into bonds, and a sliver of that goes in there. So that chief investment officer takes all that bucket of money, and he or she says, okay, I've got all these allocations, and so where am I going to go, right? Because if all of a sudden bonds rates go up higher and the rates to get a mortgage are lower, they're going to probably lean more towards a bond, right? If the risk is the same, because they're just trying to say risk versus return. Where do I get the best return for the risk that I'm going to take? Okay. So that chief investment officer, they don't really have a platform to be able to originate the loan in-house. So do you guys remember I talked about the fact that they have correspondents? Do you remember that word? So does anybody remember what a correspondent does?
I know they have exclusive rights to a certain part of the market.
Correct. Yeah. So if I'm a correspondent, so think about, here's Life Company, right? Has all the money. And they say, well, guess what? We don't know Arizona that well, and we don't have the infrastructure to originate the loan or service the loan, but we will work with you, Integrity Capital, to be our correspondent or our representative of this bucket of money in your correspondent region. Okay. And so if anybody wants to do a loan in Arizona, they have to go through you to do it. And so you're going to do the inspection, you're going to do the underwriting, and to prepare everything, and then bring it up to us. And then we're going to take it into committee, and then we're going to either approve it or not. And so we will give you the authority, and we will even, allow you to do a lot of the work, and you can even service the loan, meaning you're going to collect the payments every month. And so ultimately that's your region. Okay. And so they work with these third-party correspondents who know the market. They're set up to be able to do the infrastructure. And so that's how life companies distribute this out, because they don't have all of the people and the staff and the back end, nor do they have the desire to. It's just not what they do. They're investors, okay? And so that's what they do in their structure, okay? And if you remember, life companies are pretty risk averse, okay? So they're going to give you so think about this correlation. If I want the lowest risk, okay, that means that my return is also going to be low. Does that make sense? If I'm willing to take more risk, then I should commensurately think my rate of return goes higher, because I'm taking more risk, okay? So that means their low risk, their rate is going to be lower by nature relative to the marketplace, okay? So what they're really good at, they don't do construction most of the times, a few of them might, but it's very rare. And so they're only going to do investment properties. Do you remember the 4 kind of property types that they focus on? Anybody would take a stab at it and remember I call them the 4 food groups. Remember what those were?
Was industrial one of them?
Industrial was one of them. That's 1 out of the 4.
Hospitality?
They can do hospitality. Most of them won't, because it's a higher risk asset type. So hospitality is it's kind of an operational deal, meaning that it's not just purely investment. You're not like putting a tenant in there. You have whole operations right around it. So most of the times they don't. The 4 food groups are office, okay, retail, industrial, and apartments. Okay. So office, retail, industrial, apartments. Those are what we call the 4 food groups that they're going to go through. And so that's what they're going to lend on in general. Okay. So if you remember, they're going to look to just say it's a stabilized property. It has tenants in there. It's been paying rent, and we're going to lend against the income. Because remember, most lenders, with the exception of a few, are cash flow driven. Okay. So they want to make sure that there's cash flow. And do you remember that 4-letter acronym that I used, started with a D? That was the ratio that you guys are going to have to know inside and out last time.
Debt service, right? It's like debt service coverage ratio.
Yeah. Good job, Lana. Debt service coverage ratio. Okay. So DSCR, just memorize that thing, right? Debt service coverage ratio. That's the magic number. I was on the phone today. We're looking to place a $56 million apartment acquisition. It's in, you'll appreciate this, Lana. It's in Midland, Texas. Okay. And it's the oil town, right? It's kind of goes bang or bust over there. So Midland, Odessa, right? It's 56 million acquisition, so me and the lender on the phone, and I said, what's your debt service coverage ratio that you need in order to lend on the deal? And he said 1.3 to 1.4 times. Do you remember what I said that the minimum was?
1.25.
That's right. 1.25, right? So if you noticed, I was like, man, that seems a little higher. I'm talking to him, on the phone, and he says, yeah. He says, it's Midland. He said, it's a tertiary market. It's a riskier market. He goes, I'm going to have a higher hurdle, which means that the LTV is probably going to come down. In fact, he was at like 55% loan to value. Most of these things are usually 70 to 75, right? So there's this correlation between the loan to value, which means the amount of proceeds you're going to lend up to the total amount. So if I'm using an example and I say, well, the asset's $100, and I'm going to lend you 75% loan to value, then how many dollars am I going to lend you? If it's $100, I say 75%.
You said 70%?
75.
75. So you'd lend $75, right? That's the amount of.
Correct. Exactly. 100%. Yep. $75, right? So think about loan to value is the amount of proceeds they're going to lend against that total amount. So if the purchase price is 100 million, right, then they're going to lend 75 million bucks if it's 75% loan to value. Now I want you to think about this for a minute. If my debt service coverage ratio is 1.25, okay, and I'm saying I'm going to lend you up to this amount, you have constraints, right? Because if all of a sudden I start running the cash flow and I'm like, well, I could lend you 75%, but there's a problem. Your debt service coverage is a 1.1 at 75. So what do you think is going to happen to the loan to value?
It'll go down.
Yep, 100%. It's going to go down because every dollar you go higher, they're going to calculate a payment and that payment's going to go up, right? So in order for me to hit the ratio, they're going to say, well, you got to put more equity, right, into the property, more cash, and therefore I'm lending you less money, okay? So that's what they do when they look at a property. They're saying, well, what's the historical cash flow that is being generated on the property, okay? And that's how they determine it, is the net income, not the gross, but the net income, okay? And that's how they're going to calculate how much they're going to be able to lend you or not, okay? Based upon the historical things. So the life companies, that's their job, is they'll say, look, I'm going to lend you, I'll use a 25-year amortization. I'll fix it for 5 or 10 years. The interest rate will be 5%. They'll calculate a payment, okay? And then they'll go ahead and determine that. Now I'm going to do something for you guys because I remember when we did this last time, this is still kind of a newer concept for a lot of people. Even though I know you guys are smarty pants, but we're still going to walk through it together, okay? So I'm going to pull this up. Okay, can you guys see that? Everybody see that? Okay. So like, let's just take, for example, let's say that it's a $10 million property and I said, well, I'm going to lend you 75%. Okay. So 7.5 million. Oops, 75 million. Take a zero off there. Okay. And now I say, well, the interest rate is 5%. I'm using a 25-year amortization. Now, what is my monthly payment? Can you guys see that?
Are you asking us to say that number?
Yeah, what's that number?
Oh, 43,844.25.
Exactly. And then an annual payment is what? $526,131.04. Okay. Now see how this calculates down here with the amortization. Day one, there's $7.5 million. There's the payment. Here's how much principal goes towards that payment. There's the interest, and then that's the ending balance. So this whole amortization schedule, it goes down and down and down and down till you get to the end and it eventually becomes zero. Okay. So this is the amortization. So what we're going to do is we're going to say, okay, well, let's just take, for example, and say that the cash flow is 600,000. Okay. And so it's $600,000. What's my debt service coverage ratio? What does that show right there?
1.14.
Exactly. 1.14. Okay. So I would have to, so a couple things would have to change. So either the interest rate goes down, right? So let's just do that for a minute. So let's say you go to 4%. What just happened to the debt service?
It went up.
Went up, right? So 1.26 times, because the interest rate change means my payment went down because the interest rate was lower, right? But if everything stayed the same, then I'm going to have to change my loan amount, right? So I might have to go down to 7,250,000, and now I'm still at 1.18, right? So I might have to go down to 7 million. And now I'm at 1.22. So I'm getting closer, right? But what's happening is I'm trying to show you guys that there's a certain cash flow that's static, okay? And that is the cash flow that's on there. And then what they're going to look at is say, well, okay, here's our rate, here's our amortization schedule, and this is the loan amount we can do. And we will lend you that because we know there's enough cushion in order for you to borrow the money. Okay, so the property supports enough of the cash flow. So does that, are you guys tracking with me on that? Does that make sense?
Yes, sir.
Yeah.
Okay. Yeah. Okay, good. Because it's just important you kind of understand like what's going on in their mind and how does the mechanics work on what can they do. So the lender is looking at it and saying, okay, well, I'm going to lend you money and this is what I'm going to look at to do it. And so they'll lend a 25-year amortization. That's how they're determining the payment. Okay. And then they're going to do it on a term. So there's a certain term that they're going to go over, which means I might only fix it for 5. So there's 5 years that I'm going to do a loan for you. And then it balloons. Okay. Or I might do 10 years, or I might do 15 or 20 or 25. So there's a difference between the amortization and the term. Those two might be the same, but many times they're different. Okay. Unlike the residential world where you do a 30-year amortization and it's fixed for the whole period. Okay. It's not the case in commercial. Most commercial loans are amortized over a longer period, but they only have like a 10-year term. Does that make sense? Yes.
Yes.
No? Okay. Okay. I want to make sure you guys are with me. I'm trying to get you to go, yes, no, okay, I'm totally lost. So basically, you have to kind of know that's how life companies look at deals. They're looking at the property, they're looking at the cash flow. They definitely want to show that the borrower is strong. They want to see that their net worth, meaning that their assets minus their liabilities. If you guys understand what I mean by they say net worth. Okay. So someone's total assets minus their total liabilities, if their net worth is at least the loan amount or higher. Okay. That's what life companies look on your personal financial statement. Okay. And then they're going to take all that information and say, I'll lend you this money and I'll do it for a long period of time. And then their prepayment penalty is really stiff. So that means they just want to put this thing to bed, collect their coupons for 10 years and just put it away, right? That's the business they're in, okay? Banks are really focused on owner-occupied loans. They like those small business owners, remember that? Life companies are really focused on, the investor and these apartment owners and the industrial owners. That's what they do really well. They don't do construction, banks do, okay? So they can't really compete with the life companies, the banks can't, because their rates are not as competitive, okay? This is where they shine really, really well, okay? So that's just kind of high level on a life insurance company. Does anybody have any questions about that at all on the stuff you do? I just want to make sure you kind of understand, how they function, what they focus on, how they deliver it to the marketplace. And so questions about that? Make sense?
Makes sense. Yes, sir.
Okay. All right, so let's move on to the CMBS loans. Okay, does anybody want to take a shot at what CMBS stands for? I want somebody besides Lana. She's answering all the questions. So I love you answering, Lana, but I'm going to make someone else answer.
It's commercial mortgage-backed securities.
That's exactly it. So commercial mortgage-backed security. Okay, so commercial mortgage-backed. So what do you guys think that means? So commercial mortgage-backed security. Will, what do you think?
Well, I mean, I think it has something to do with, I see the word securities and I automatically think stock market, and that makes sense because seeing commercial mortgage-backed securities are linked to the stock market. So that's the first thing that comes up in my head.
Yeah, it is. These are tied to the stock market or bond market. Okay, you guys remember the mechanism by which they do it. So this loan that gets originated, they're doing it with the intention of putting in this big bucket, okay? And then what they're going to do is they're going to take that out into the market, okay? So if you kind of think about in your own mind, okay? So I'm here and I am the CMBS company, okay? Here's a good way to think about it. I'm like a gigantic broker, okay, that has a big line of credit, and I'm never going to hold that loan on my balance sheet. 100% of my intention is to book the loan, but even before I book it, I'm going to pre-sell it to somebody, okay? I'm never going to hold the paper. I might hold it for like 45, 90 days, but my intention is to get rid of that thing as fast as I can, okay? So if I book it for X, okay, then that means I want to make a profit on it at Y. So if I book it at a 1, I want to sell it maybe at a 1.05, okay? So I'm making this sort of spread between those two. And then they're going to tranche that whole thing up into this ginormous bucket, and then they're going to securitize it and sell it off as bonds and stocks to you and I as the consumer to invest in these mortgages, okay? So they're going to make the cash flow that comes off of the payments, and then this person made the difference between those two. You guys tracking with me so far? I'm trying to just give you a sort of a visual mechanism. So questions about that?
In the videos as well, I looked it up, but I didn't completely understand. Could you define the word tranche?
Yes. Yeah, good question. So a tranche is like, it's basically like a bucket, okay? So if you think about like a tranche is what I'm doing is I'm putting in all these loans into different buckets. That's probably a different way to think about it. And then within the tranche, so let's say that I have a tranche of, or a bucket of loans that is $1 billion, okay? And let's say that they're all multifamily loans. Okay. So I've got this tranche or bucket of loans. Okay. And then what'll happen is that in that tranche, they'll peel off riskier portions of the loan. Okay. So they'll do like what they call an A and a B piece. Okay. And that B piece is a riskier portion of it. So what it means is that they're going to charge a higher yield or a higher return to that piece of the B piece. So if I'm a big investor, so again, remember here's CMBS big broker that has a line of credit that's booking these loans. And then here I'm Mr. Investor. And I say, well, I'm going to buy these loans because then I can turn around and make some money on them. Or I'll just make a yield. So like I'm a big pension fund and I say, I'll just buy some CMBS loans. So I say, well, based upon the risk, remember everything's around risk and return. I say, well, yes, that B piece looks like it's paying me like 15%. Okay. And I risk rate it and I go, well, I'm willing to take that because that's a great return. So I buy that strip or that tranche of loans that's riskier out of the bucket of loans. And then I get more risk. Okay. Because I'm taking the riskier loans on, but I'm also getting a better return. Okay. And so these people that are buying them are the ones kind of doing their homework to go, hey, let me see this big ticker of all these loans and I'll do my own due diligence to see if I want to buy them or not. So does that answer your question, Lana?
Yeah, so the tranche is the whole group of them, or the tranche is just piece A and piece B?
The whole tranche is like, it's the whole bucket. And then
Okay.
you peel out little pieces of like the A and the B piece. Okay.
Okay,
Does that make sense?
thank you. Yeah.
Good question. Really good question. This is tricky. This is tricky stuff. Okay. Especially on the backside. And then, so you got all these parties. So CMBS lender, big broker doing the origination on the front side, pre-selling to investor over here. Then you have another party over here, which is the rating agency. So like Moody's rating agency will come in and they'll look at the whole bucket of loans and they'll rate them. Okay. And they'll say, well, these are rated triple B or double A or triple A. So they'll look at the risk and they'll rate them to see, if they're risky. And then that determines, okay, how they will sell in the marketplace. Okay. So it's kind of like, it would be similar to be saying, hey, I'm going to sell you a Walgreens that's on the corner of Highland Park and blah, blah, and it's right in the downtown best area. Or I'm going to sell you Joe's Crab Shack that's in, the middle of nowhere in Midland, Texas, right? So what happens is you're like, well, how much? And you're like, well, you're going to pay a premium for the Walgreens that's right in the heart of Highland Park. But you're going to pay less and get a better return if you buy the deal Joe's Crab Shack in Midland, Texas. Okay. Because you have more risk. Okay. The oil market goes haywire and people leave Midland and blah, blah, blah. Right. So that's kind of the mentality you need to be thinking about, is how they do these things. Okay. So you guys tracking with me so far on how the mechanism works?
Yep.
I have a question about that actually. So say that an investor wants to get into commercial real estate. He would go to a CMBS company and say, hey, like I'm looking to invest. And then kind of what you just explained. I'm just kind of trying to focus on the kind of the map of it, like how it works,
Yeah. So there's one more party. Okay. So the CMBS would be tantamount to a bank or a life company. They're just lending the money, right? So the investor, so if I am a commercial real estate investor that's buying properties, okay, I'm going to buy a property and then I would go get a loan from the CMBS lender. Does that make sense? So the CMBS lender is lending the money to the investor So if that investor comes in and says, I'm buying this property, okay, for 10 million bucks, and you're going to lend me 75%. Okay, so they're going to lend them 7.5 million bucks. Okay, and they say, well, we'll do a 30-year amortization, and we'll do a 5% rate, and so they'll lend the money to the investor. So if you're the investor buying the apartment complex, you're buying the apartment from the commercial broker who's selling it for the seller, and you're the buyer, but then you either going to pay cash 100%, or you're going to put 25% down and then go borrow the rest of the money from either a bank, a life company, or a CMBS lender. Does that make sense?
It does, yes. Thank you for clarifying that for me.
Yeah. So this is just another bucket of money, a type of lender that is going to go out and lend money in the marketplace. And you ask yourself the question, well, what makes them different? And here's what it is. A CMBS lender, generally speaking, is going to lend on larger loans. Okay, they can go up to hundreds of millions of dollars. Okay. And they usually are lending higher loan to value. Okay, then like a life company is super conservative. CMBS lenders aren't as conservative. Okay, they'll push the envelope to get higher proceeds for somebody. So if somebody says, hey, I just want to put as little down as possible, they'll go to the CMBS lender. Okay, or if there's kind of a little bit of a funky thing about it, maybe it's a newer tenant or something that's a little bit quirky, they'll go to the CMBS lender. Okay, and they'll do non-recourse lending. Non-recourse lending means nobody's going to sign a personal guarantee. Okay, so Lana, if you went and borrowed money, they're going to say, okay, well, Lana, you're going to sign these loan documents, and you're going to sign a promissory note that Lana's going to promise to pay me the money back. Okay, and you say, well, okay, great, but what does that mean? And I say, well, if you default, Lana, I'm going to foreclose on the asset, but if I don't get all my money back from foreclosing, I'm going to come after you personally. Okay, and that means I'm going to go after everything, your bank accounts and garnish wages and blah blah blah. Okay, well, when you do a non-recourse loan, that means they're not. Okay, so they're not going to have you sign a personal guarantee. They're just going to say, look, we're focusing 100% on the asset. Okay, but what they'll say is we will do non-recourse, means no personal guarantee, with a caveat. Okay, so they'll say, I'll give you a loan with no recourse, but only if you don't do a couple of things. And I just call them the bad boy naughty provisions, right? No fraud, right? If they find out there's fraud, the whole game's off, right? If they found out you were dumping chemicals in the backyard, right, the whole thing's off, right? So there's a couple of provisions in there that says, look, if there's massive negligence and you just let the thing go to the pot, then obviously this is not null and void. Okay. Otherwise, it's a non-recourse loan. Well, people like that. Investors are like, hey, I don't have to sign personally. I like that. Then I'm not stuck. So that's just something that they offer that a lot of lenders don't. Okay. Now, here's the downside with CMBS loans. I'm not a big fan of them. Okay. If I'll give you a perfect example, it's happening right now. If all of a sudden the market gets really shaky, okay, and all of a sudden things are getting a little bit uncertain in the marketplace, they go from lending to totally out of the market like that, okay, without even blinking an eye. You could be right in the middle of a loan. You could got your commitment letter for your acquisition, and they call you up one day and they go, sorry, we're not lending anymore. And that commitment I just issued, it's out. It's off the table. I'm not going to lend you the money anymore. So that is really kind of freaky. It's like, oh my gosh, we just spent all this time and money and da 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 da. And they're like, we're not going to do it. Okay. So that's the distinction with a CMBS. I don't really like them that much. I've done them before. I've done plenty of them. They certainly serve their place, and we do them if we have to, but that freaks me out because I'm always like, gosh, I want to get that call, because then you have to call the client and go, sorry, this just blew up. Okay. So does that make sense?
Yes.
I actually had a question on the yield maintenance prepayment penalty, or just like prepayment penalty in general.
Yeah.
Like, what does that entail?
Yeah, this is a tricky one, and I'll send you guys a video that will explain it a little better too. So there's these different types of prepayment penalties. Okay, there's like step down prepayment penalties, which is pretty straightforward. It's like 5, 4, 3, 2, 1 means if you paid off in the first year, it's 5% of the loan amount. Second year, it's 4%. Third year, it's 3%, 2%, 1%, and then it's out. Okay. So that just means whatever your balance is outstanding in year 5, or let's just see even at the end of year 1. So in this case, you would still have 7,408,000. So if I say, well, you owe 5%, okay, on that amount, 5, okay, well, that's $370,000, okay. So, but it's clear, like I know what it is, right? If I do yield maintenance, then what happens with yield maintenance is I'm saying, okay, well, here's how it works. So life company comes in and says this, I'm going to lend you, EJ, okay, $7.5 million, okay, and I'm going to lend it to you at 5%, okay. 5 years goes by and it's a 10-year term. Okay, so 10 years are going to go by. So year 5, EJ gets a call from this guy and he says, EJ, I'm going to buy your property for 20 million bucks. And you're like, sold, take it. I'm out of here. So you're like, okay, well, so now year 5, okay, so 60 months down the road, you owe 6,887,000. Okay. So there's the amount. Okay, so that's how much you owe. So you're like, I'm going to make some coin. It's awesome. And the lender says, okay, well, here's the deal. You have 5 years left on your loan. And a yield maintenance provision basically means, I call it a make whole provision. It basically means I'm going to make every amount of dollar of cents that I would have made if I would have kept the loan for the whole life. Okay. So for example, if I'm the lender who lent you the money for 10 years and I go all the way down to 120 months, okay, then I would have made in interest $3,432,000. Okay. So what happens is they say, so here's the deal. We're going to use a benchmark of the treasury bond. So they're going to go out into the treasury bond market and they're going to say, we want to be able to replace the money and put it into a bond. And let's say that bond is 3%. Okay. So let's start walking through this. They lent you the money at 5. You have 5 years left, and the new rate for them with the 5 years left is 3. Okay. So what's the difference between the 5 and the 3? What's the gap?
2 years.
2. Okay. So they're losing, the lender's losing 2% on their loan every year for 5 years. Okay. So what they're going to say to you is they're going to say, EJ, here's the deal. You are essentially going to pay us the difference that we're losing and what we'll make when we put the money in the treasury market. So they're going to say, we're going to multiply this times 2. So what's that amount right there?
$137,743.
Exactly. Now, here's the difference. It gets worse. Okay. That's just per year. And they're saying, well, you have 5 years left on your loan, EJ. So we're going to make you pay us for 5 years of that. So what's that amount?
688, 715.
That starts to get a little ouchy. Okay. So what happens is there's a little bit of gambling going on here, because as I get closer to maturity, the years go down, but that treasury bond, chances are, is going to be lower and lower. Now, if I'm in an increasing market where the rates are going higher and I book the loan, maybe it gets a little better for me. Okay. And so that gap could shrink, because I could say, well, I booked it at 5 and the 5-year treasury is 4. Okay. Well, if I just change that to 1, it just cut it in half, right? So as that margin shrinks, then it's the less that I have to pay. And you might say, well, gosh, Dave, what if it's the same, 5 and 5? Well, then they'll say you only have to pay us 1% origination, right? But there's never a point where they say, well, you say, well, Dave, what if it's 6? Mine's 5 at 6. You still have to pay them 1%. They're still going to make out like a hog, but you still have to pay them. Okay. So that's kind of, I mean, it's more complicated than that, but that, I'm just trying to give you sort of a simplistic way to visualize how yield maintenance generally works. And those two kind of go hand in glove, like defeasance and yield maintenance generally go hand in glove. So does that make sense?
Yes, it does. Thank you.
Yeah, good question. Really good question. So that's kind of CMBS loans. There's a lot more, but for the sake of time, and there's, we're not going to go into the weeds yet. That's down the road. But I'm just trying to give you kind of mechanisms of like, what are these lending types? Okay. So we talked about CMBS, talked about life company. We talked about, banks, life companies, CMBS. Now we're going to talk about hard money lenders. Okay. So you guys remember, Evan, do you remember what a hard money lender is?
Yeah, it's usually somebody who's a private loaner, and it's usually a pretty risky endeavor, if I remember correctly.
Mm-hmm. Yeah, it's a private lender. They are lending only against the asset. Okay. They are not concerned about the person necessarily, maybe a little bit, and they're not really concerned about cash flow. They're only worried about the collateral. Okay. So they're going to, and we've done many of those in-house. So someone comes in, okay, I'll give you an example. We had a guy who's spent like 4 years developing this business where he was going to, he developed this technology for parking in all these garages for, like airports, okay? Because people get lost and they lose their car and there's just tons of inefficiency. And so he designed all this technology, and he basically was working for 4 years to land a contract with LAX. Well, as you can imagine, he wasn't making a dime of money for 4 years, right? He was just like spending tons of money. And so his credit was shot. He finally landed it. It was like a $30 million contract. And he landed the contract, but he needed to buy a building. Like he was going to blow up now and grow a business. Well, he came to us and he's like, look, I need to get a loan. And I'm like, we can do it, but we can't get you a conventional loan because you have no history, your credit shot. So you're gonna have to put down like 35% on the property, and it's gonna cost you like 10%. Okay. And so it's all we cared about was, I liked the real estate. It was in Scottsdale. We lent him 65% of the loan. It was like $3 million. And he paid us interest only 10% for like 2 years. And what we told him, we said, look, you just need to get a tax return or 2 under your belt, and then you can go get a bank loan to take us out. So sometimes you'll hear this like bridge loan or an interim loan. That's really what a hard money lender does. They just are going to look at the collateral and say, if I ever had to foreclose on this, I'd be happy to own it. I don't want to, but that's the way I'm looking at it. Okay. So they're really in the business of doing short-term loans, higher interest rates, because it's risky. You don't really care about the borrower per se. But you're just looking at the collateral, and you close fast. You don't ask for tax returns. You're not really looking at anything much other than, does the property make sense? Okay. They are riskier loans because you're dealing with someone that could have, they could be totally, bamboozling you. You don't know. But it is something that gets done, and there's tons of lenders that do hard money loans. I would say in our firm, we do like 5 to 10% of those a year. It's not a big amount. And the reason why, because a lot of times they're kind of shady. Sometimes I'm like, I don't know if this deal makes sense, and I don't know if I'm comfortable with the borrower. Okay. So we just kind of wash our hands and go, we don't, not going to do it. Okay.
Mm-hmm.
So does that make sense when I'm talking about hard money lenders?
It does. I am kind of curious though, is the interest rates the only thing that makes a hard money loan so risky? Or does it have to do with kind of like what you said with the loaner being a bit shady?
What makes it risky is that you're not going through the same thing you would if you were a traditional lender. Like you're not asking for tax returns. You're not
Right.
asking for credit reports. You're not looking at their personal balance sheet. Sometimes you might, but it's rare. You might not even get an appraisal. All you're going to do is you might call a couple of commercial brokers, get a sense for what you think it's worth, and then close on the loan. And you're closing in like 10 days. So it's super fast. So the risk factor is just higher because you're not doing the same amount of due diligence. Okay. That's why the return is higher, because you're saying, well, you might default and then I have to go through and foreclose on you. And, that's kind of a nightmare. Does that make sense?
Yeah. Thank you.
So there's lots of those guys out there. Some of them are shady, but there are plenty of legitimate lenders that do it. A lot of people do fix and flips. They go buy homes and they'll have to close in like 3 days, and they'll just, they'll get a hard money loan and turn around and fix it and flip it. Okay. So so that's a hard money lender. Do you guys questions about that or comments? Okay. Good. Then we have bridge lenders. Okay. So a bridge lender is a little bit different. They generally do in larger deals. Okay. So they're going to do something like an apartment complex, and the apartment complex maybe was run down, wasn't really managed that well. It's kind of beat up and tired. So someone comes and says, I'm going to buy that thing and I'm going to clean up the units. I'm going to put in like $10,000 a unit and make it look really pretty. And then I'm going to increase the rents. And then I'm going to turn around and get a traditional loan when it's all done. Okay. So essentially a bridge lender is lower on the interest rate, but they're higher than a bank. Okay. So they'll be probably, in today's environment, they're probably, 7 to 8%. Okay. Where a hard money lender might be 11 to 12. A bank is going to be 5 to 6. Okay. So they're going to take more risk because there's probably not cash flow. They're generally non-recourse with carve-out provisions, and they're going to lend about 65 to 70% of the total cost. Now, remember, if I'm doing a bridge loan, I have to understand the purchase price. Plus, I need to also understand what the renovation budget is. So if I say, well, I'm going to spend, I have 100 units and I'm going to spend $15,000 a unit, then my budget is going to be what? 1.5 million bucks. Okay. So I'm going to buy it for 7 million. I'm going to put another $1.5 million on top of it, clean it up, get new carpet, new, tabletops, kitchen, cabinets, increase the rents. Now I got this clean property, and then I'm going to go to the life insurance company, or I'm going to go to Fannie and Freddie and get a nice permanent loan. Okay. So think about a bridge. It takes you from here to here. Okay. So bridge lenders are just taking somebody from point A to point B, and then they're going to take it out either by selling it. So they add some value and then sell it, make a profit, or they're just going to go ahead and do a long-term fixed loan. Okay. Does that make sense? So that's what a bridge lender is. Yeah, go ahead, Lana.
You said that the rates are 5 to 8%, right? 16.
Yeah, they're probably in the, I would say right now, they're probably 7 to 8%.
Okay, I think this is just something small. I think on the quiz it might be set to the wrong correct answer. I think it's well, when I did it, it said that 3% was the right one. So yeah, I just wanted to say.
Oh, good. Yeah, thank you for letting me know. So I'll make a note of that. Yeah, because it's definitely not 3%. So yeah, thanks for letting me know on that.
Another quick question. I heard this a couple times in the videos. Fannie and Freddie loan. What is that exactly?
So great question. That was the next one. So Fannie and Freddie is an agency lender, and an agency lender is they're called a DUST, or a designated underwriting servicer, and they represent the federal government for the housing authority, and they can lend all these different product types, but basically Freddie and Fannie lend to anything with homes that people live in, you know, senior housing, apartment complexes. And so they'll do these long-term fixed loans that are like 30-year amortizations, fixed for 5, 7, or 10 years. And they're specifically for like apartments, okay? They can do low-income housing apartments. They can do normal apartments. They can do senior housing care authority. It's just really anything with beds and homes that you live in. And that's their whole designation. I would say the majority of apartment loans will get done with Fannie and Freddie. And the reason why is because they have artificial rates that are much lower than the marketplace. And so it's cheaper capital. You know, if somebody's lending at, 5%, Fannie's probably 4%. Okay. And so again, same type of thing, 30-year amortization, 10-year fixed, lower interest rates, prepayment penalty is yield maintenance typically. And they're just looking again at cash flow, making sure it makes sense. They'll lend 70 to 75%. And you can do interest only sometimes for a couple of years, as opposed to having an amortizing payment. So that's what Freddie and Fannie is in terms of the lending type. Okay.
Do they lend to single family houses as well? Or is it just
Well, they do. Yes, they're Fannie and Freddie, and like FHA loans, right? That kind of falls into that same bucket. But just for the sake of what we do, we don't get into the residential homes. We just deal with apartments, which typically is anything above 4 units. Will fall into commercial. That's how they classify them when all is said and done. Good questions. Any other questions about that? Okay. We're coming up on some closure here, but did you guys go through sort of what your role would be at Integrity Capital? What did you guys think about that? Any thoughts, comments, questions? Did it make sense to you?
I need to probably read through it a few more times and everything like that, but it definitely made sense to me for the most part.
Okay, good. Okay. So my question to you guys is, did you guys do the innovation project yet?
The PowerPoint and everything is complete. We were going to do a Zoom to record the video, and then we've just been kind of troubleshooting. So we're individually recording our videos, so we should have it in release, and everything's prepped and ready for it then.
Awesome, great. I'm excited to see it. So I know you guys put a lot of work into that. And so, so that kind of concludes, the session for us. And so is there any other questions or comments that you guys have before we wrap up our session for today?
I don't think I have any.
Good, good. So what I'm going to do, so in the next, like I said, 24 hours, me and Michelle are going to reach out to each one of you individually. So we'll give you a call, and I just want to say thank you, like to each one of you guys. Just thank you for like diving in and working hard and just getting all this stuff put together. It's a lot, and so I just want to encourage you, like. I know it's a lot because this is still conceptual for you, but if you kind of proceed, it's all going to sort of like come together. It's just sort of when your hands, start getting dirty and you start getting your hands on, you'll go, oh, okay, this makes sense now. But it's okay because it's still conceptual for you. It's kind of like if I told you, hey, Will, let me have you read a book on what it's like to play football. But until you actually get those pads on and get hit by the guy across from you, you're like, oh, now I'm starting to understand what this means, right? So it just kind of takes some time to germinate. So don't be discouraged about that. So anyway, thank you guys. I'm so thankful for you, and we will be back in touch with you very soon. And I hope you guys have an awesome day. Okay.